It's not just the energies on the minds of traders this morning. With all the recent developments in trade, Brexit negotiations, Stephanie and I were talking about a little bit earlier in the show. We've got central bank activity, and oh, don't forget, we've got some inflation data headed our way in just a few minutes. So let's head on over to the Chicago Board of Trade, where we have Bob Iaccino. He's the founder and chief strategist of Path Trading Partners, joining us this morning for a look at the financial markets. Bob, good to have you with us this morning. I appreciate you setting aside part of your morning to join us. Let's talk Brexit first with the latest. And is it still looking like Theresa May is going to have a tough go at pushing her agreement past Parliament?
Well, I think it's pretty tough to say, Ben. She's over in Europe now, I mean, presumably trying to adjust some of the terms to make it a little bit more palatable to Parliament. It was pretty widely known by her as well that she was going to lose the vote if it happened. So obviously the postponing of the vote is old news. But I would guess she's over there trying to figure out some of the issues with the Irish border and some of the other things that bother the hardline Brexiters. But some of the talk I've heard is that the public in the UK is getting a little tired of the hardliners. The popularity of a Brexit just in and of itself is not where it was when the referendum happened. So I'm not sure. She may actually be gaining a little bit of strength from this that she didn't have a week to 10 days ago.
Bob, is it still the Irish backdrop, the border issue that they're debating?
Yeah, it's one of the main ones. And then a couple of the trade things where trade agreements, portions of the agreed upon Brexit, really makes it no different than the EU. There's a couple of codicils in there that basically say that the UK has to combine with the EU with trade agreements with certain countries. So it essentially leaves them as kind of a minor member of the EU, according to the hardliners. I did not read the document. So it's not something that I'm assuming. I don't intend to read the document either. I intend to see some basing in the pound and then get long it when I do see it, but we're not seeing that yet, other than some of the sort of ancillary effects from the weakness in the dollar you're seeing right now.
Yeah, it sounds like from the details in terms of this deal that they would still be, well, for the most part, in the block, it seems like, but without representation. Right. Let's stick with the UK because it's not all bad news. I want to point out overnight they had some pretty strong jobs numbers, which came in. Average weekly earnings were up 3.3%. That's year to year. This is the biggest increase since July 2008. Bob, they had unemployment, the lowest they've seen since 1970. Are we starting to see the ripple effect from tight labor conditions here in the U.S.?
You know, it's interesting. That's a good way to look at it, Ben. I didn't think of it that way. It's coming off the back of some pretty weak industrial production and manufacturing numbers in the UK, although it's not much of a manufacturing economy. So based on what you just said, which I may steal from you later in the day, is it now the financial strength of London itself with an actual Brexit looking like it might happen in one form or another, kind of resuming? I mean, one of the places that we saw some growth in that labor number you just mentioned is in the services sector, breaking that down in the financial sector. So there was some concern that London wouldn't be the financial center it's been. You and I have known for years, you're talking New York, Tokyo, and London. When you're talking about financial centers, London probably being the largest during certain decades. That was looking like it was going to shrink if Brexit became a problem. If Brexit actually ends up happening with agreed upon Brexit, presumably that makes it easier for some of the money center banks to leave the offices there that they threatened to move out.
Hey, Bob, China reported new loans were up overnight. We heard of trade talks between the U.S. and China again in the overnight session. Bob, does it feel to you like we're making progress, or is this the 90-day hold on tariffs just avoiding the inevitable?
Well, I don't know if you saw the President Trump tweet that came out a few minutes ago when you were talking to your prior guest. But President Trump basically just tweeted this morning that there's some really great conversations going on. Watch for a big announcement. So that came out a few minutes ago. So it's interesting to see. We saw a tiny little spike in the equities. So maybe. On the back of the China data, I wouldn't say so. For me, the new yuan loans might actually be a concerning trend when you look at some of the other data that's in the backdrop. They had an ISM at 50. Right, that's the first time in a long time they've been anywhere near 50, which of course is that fulcrum between expansion and contraction of an economy. And then they missed their export number by almost half. Was expected to come out up 9.4%, came out up, but up 5.7%. So the contraction in China is real. Perhaps that's why some good conversations are going on. Perhaps that's why they're still having negotiations in light of a CFO of a major technology company, daughter of the founder, being held in Canada at the behest of the U.S. I still find it odd, Ben. I might have mentioned this to you, might have mentioned it to Oliver, I'm not sure. But I find it very odd that President Trump and President Xi Jinping have not commented on this arrest directly.
Yeah.
I find that very strange. And it happened the day after their dinner, or 2 days after their dinner. So I find that odd. I mean, there may be something going on behind the scenes we're not aware of. That could be the positive sign.
Yeah, well, we'll keep a close eye on this one. And also, Bob, I want to keep a close eye on some of the economic data which is headed our way. This morning at 7:30 a.m. Central Time, we get the PPI FD. We've got CPI coming out a little bit later on in this week. Retail sales, industrial production. So we'll get a little bit of an indication in terms of some of the inflationary pressures and the consumer here in the U.S. Talk to us about what you're going to be looking for here this morning in terms of PPI and the release at 7:30.
So it's interesting for the viewers watching. I know Ben from the floor behind me from a while back when PPI used to matter.
Yeah.
So over the last 2 to 3 years, PPI hasn't really moved CPI. So it lost a lot of its sort of oomph. However, given the labor tightness we've started to see, we did see a little bit weaker wage growth and hourly work week in the prior non-farm payrolls, but prior to that, and I believe I was on with you when this happened, PCE productivity came out and was stronger. So if we're actually starting to see labor tightness, wage growth, PCE productivity increasing, which is one of the sort of precursors to GDP growing, maybe PPI actually starts to get a little bit of a boost again because CPI may not be able to hold out if all the factors going into consumer prices are starting to rise, which would be wages and producer inputs.
All right, well, something to watch here, Bob, in terms of the producers' prices and if they are seeing a bit of a lift, again, in terms of some of the conditions you cited. Bob, we got to hop here. We're going to take a quick break, but I'd like to get your thoughts on the treasuries and the rates when we come back, so stick with us because we've got more with Bob Iaccino, the founder and chief strategist of Path Trading Partners. We've got more of the information you crave about the futures markets you trade right here on the TD Ameritrade Network after this short break. We're back into the break. We were talking currency markets with Bob Iaccino, the founder and chief strategist at Path Trading Partners. And Bob was kind enough to stick with us through the break, so let's welcome him back. He's the founder and chief strategist at Path Trading Partners. Mr. Bob Iaccino, I want to have a look at the treasuries, but first let's take a look here at the market reaction to that 730 PPI-FD number. Bob, you were right. You called the potential for it to come in a little bit higher than expected. Talk to us. I'm noticing the treasuries are actually seeing a bit of a bid come into play. I'm noticing the indices, for the most part, continue to hold upper levels. What are you seeing in terms of market reaction, Bob?
Yeah, a little bit of hot sauce in those month-over-month numbers. Both the headline and the ex-food and energy beat by 0.2. I did not see the year-over-year number, which I think is a little bit more critical. But those month-over-month numbers driving treasuries, as you mentioned, a pip or two higher. Interestingly enough, we now have the 2s, 3s out of their inversion. Okay. The 2s, 5s, this is as of yesterday's close. I don't know where the 2s, 5s is now. That was still inverted by basically 1 basis point, so you can call that flat. That's good news because these were not the kind of inverted yield curves that signal a recession, not by a long shot. Those blips into inversion do not signal recessions. Also, you need a different section of the curve to go inverted and stay inverted. So that's a good thing. We're also seeing that December rate hike probability creep up. It got as low as 64% 3 to 4 days ago. I don't remember exactly which one, Benny, but it's gotten back above 75% now and creeping higher because the market is now under this perception that December is going to be kind of a one and done wait and see situation for the Fed. And all of that's really good for equities. And these are binary events now. If you combine that with all of a sudden some actual colossal announcement, it looks like China's moving forward on getting rid of those auto tariffs. We're seeing a little bit of spike in companies like Volvo, who make some cars here and then sell them in the Pacific Rim. So you're seeing spikes in those kind of stocks. So it looks like these things are moving forward, again, in spite of that arrest. The bail hearing continues today in Canada for the Huawei CFO. So it looks like we might be moving forward on some positive things. This will drive yields on treasuries higher, not markedly higher to where they're going to affect equities, but higher to a comfortable level, I think, at least in the short term, where stocks can rally without worrying about a recession.
So glad, Bob, I'm glad you were talking yields there because, well, one of the things that we've been watching throughout the year has been the rate differentials, the disparity between rates here in the U.S. and as they're on the rise and those around the globe, which for the most part have remained flat. We talked earlier about the strong jobs numbers out of the UK and the bump in wages that we've seen. Is this a trend that we're seeing? Is this the trend that we've seen in 2018, the same one that you'd expect us to see in 2019, or are you seeing a shift taking place?
That's tough to say at this point, Ben. What I would point out to the traders watching you is that different sections of the curve are affected by different things.
Okay.
And there's a little bit of a lack of knowledge or a lack of education. It's not a difficult thing to grasp, but looking 2 years and in, sometimes a 3-year note, those can be affected by the Fed.
Okay.
When you get into that 5, 7, 10-year part of the curve, the differentials to other countries is the biggest factor day to day that you just mentioned, specifically Germany. German boons, especially to 10 years. Part of the reason the 10-year yield has stayed so low and gone lower is because German boons came off when the German economy started to weaken in terms of the data. And then the long part of the curve is inflation here in the US. 30 years, 20 years and 30 years, not many 20 years issued or out there to worry about, but 30 years, you're talking about inflation expectations. So the curve itself, when you put all those things in play, it usually can signal an economy in trouble, but it's based on a couple of things. What's the Fed doing? What's going on in Europe? And what's going on in the inflation picture? So those things are very important to point out. In terms of 2019, you know, Ben, I'm the guy calling for I was calling for 3.5% 10-year at the end of 2018. So I'm not sure I'm the right guy to ask, but I'd reiterate that because I think these trade woes are going to go away. I think they have to, especially if the president's looking to get reelected. They have to go away. They can't be a sustained thing. So if they get sort of political wins, you can put these things aside. China gets to claim they win. The U.S. gets to claim we won. And then you get back to business and stocks rally and yields start going higher again.
So Bob, you know, we've seen treasuries on the move in reaction to the strength or weakness in the indices. We've seen the US dollar and information like economic data that we just had moving treasuries as well, but they can also move in reaction to auction results, which show demand or lack thereof for US debt. This week we have the 3-year notes today. The 10-year is going to get auctioned off tomorrow, and then the 30-year bonds on Thursday. Should we expect softer demand as rates have been coming off some over the last few weeks?
It's likely, yes. And also the amount of the auctions have been steadily growing.
Increasing, yeah.
Another thing sometimes traders don't understand is that when we go into bigger and bigger debt and bigger deficit, it has to be funded short term prior to tax receipts rising if that's what's going to happen. So when you see these just kind of increase, well, obviously it's supply and demand. At the end of the day, everything boils down to supply and demand, and the supply of treasuries has been steadily increasing, keeping the prices lower, keeping the yields higher. But in this particular case, in the short term, if that demand weakens, they have to put a higher yield on it. The higher yield at this point in time might be viewed as a good thing, so weak auction might end up being a decent thing for the equity market specifically.
All right, well, it's gonna give us something to watch here, Bob, and treasury markets in general and the bid recently that we've been seeing as this dollar continues to hold near the highs. And hey, Bob, that was a great explanation in terms of the impact and the movement that we see in the shorter end of the curve all the way through the belly and into the longer end, and how, well, the Fed versus inflation can impact rates and yields. Bob Iaccino joining us. He's the founder and chief strategist at Path Trading Partners and helping us break down some of the movement we've been seeing in the financials.